Embarking on the investment journey can be daunting, especially when you're new to the game. The fear of making a wrong move and the complexity of financial markets can paralyze even the most eager beginner. But what if you could peek into the playbook of the greatest investor of our time? In this enlightening video, we distill the wisdom of Warren Buffett, the Oracle of Omaha himself, to arm you with strategies that are not just powerful but also beginner-friendly. First, invest in what you know. Warren Buffett's guidance to invest in what you know is a cornerstone of his investment philosophy, encapsulating the wisdom of sticking to one's circle of competence. This principle urges beginners to channel their investments into industries and companies they are familiar with or possess expertise in. The rationale is straightforward. When you understand a business, you're better equipped to evaluate its long-term potential and inherent risks. This approach not only mitigates the likelihood of unpleasant surprises, but also instills a greater sense of confidence in your investment decisions. By investing in familiar territories, you can more accurately discern between fleeting market trends and genuine value, allowing for more informed and strategic investment choices. Buffett's own success is partly attributed to his adherence to this principle, investing heavily in sectors he thoroughly understands. For the novice investor, this advice serves as a safeguard against the complexities and volatilities of the market, ensuring that their investment journey is both prudent and aligned with their knowledge base. Value and stock price. Warren Buffett's investment strategy emphasizes the importance of distinguishing between a company's value and its stock price. He advises investors to concentrate on the intrinsic value of a business, which is determined by analyzing its fundamentals, such as its earnings, dividends, assets, and growth prospects, rather than being swayed by the often volatile and emotion-driven stock market prices. The essence of this approach lies in identifying companies that are priced below their true worth by the market, a concept known as buying with a margin of safety. This method not only provides a cushion against errors in judgment or unforeseen market downturns, but also sets the stage for potential substantial gains when the market corrects its pricing. By focusing on value over price, investors align themselves with the company's long-term performance and health, rather than short-term market movements. This value-oriented approach is at the heart of Buffett's philosophy and is key to building a robust and profitable investment portfolio. Let's dive into the third lesson, compounding interest. The rule of compounding interest is often hailed as the eighth wonder of the world, and Warren Buffett is a testament to its power. Compounding is the process where the value of an investment increases because the earnings on an investment, both capital gains and interest, earn interest as time passes. This effect can turn modest savings into a substantial nest egg over time. Buffett's advice is to start investing as early as possible because the longer your money is at work, the more profound the compounding effect will be. For beginners, this means that even small amounts invested today can grow significantly over decades. It's not just about the money you invest, but also the time you give your investments to grow. The key is to reinvest dividends and other returns rather than spending them. By doing so, you're allowing your investments to generate their own earnings, which are then reinvested to generate their own earnings, and so on. This cycle leads to exponential growth over the long term, which is why Buffett views compounding as a powerful tool in wealth creation. Reading and learning continuously. Warren Buffett's voracious reading habit is integral to his success as an investor. He famously reads about 500 pages a day, ranging from financial reports to entire books, which equips him with a deep understanding of the market dynamics and business operations. Buffett's approach underscores the importance of lifelong learning and staying informed about the broader economic environment and specific industries. For investors, this continuous education can mean the difference between making a well-informed decision and taking an unnecessary risk. By staying abreast of market trends, economic indicators, and company-specific news, investors can better anticipate changes that might affect their investments. Moreover, reading widely and deeply enhances one's ability to think critically and independently, qualities that Buffett prizes and attributes to his success. Buffett's advice to read and learn continuously is not just about staying current. It's about building a knowledge base that allows for more nuanced understanding and insight. This habit can empower investors to identify opportunities and threats early on, giving them a competitive edge in the marketplace. It's a discipline that requires time and dedication, but as Buffett's track record shows, it can pay dividends in the long run. Let's talk now about patience. Patience is a virtue in life and a necessity in investing, a principle that Warren Buffett champions relentlessly. He likens investing to a game of baseball where there's no penalty for not swinging at every pitch. You can wait for the perfect opportunity before you take a swing. Buffett's success is not a product of market timing or chasing hot stocks, but a result of his patience and willingness to wait for the right company at the right price. Buffett's approach is grounded in the belief that the stock market will inevitably offer opportunities to buy great companies at fair prices. But these opportunities don't come around every day. Therefore, he advises investors to resist the urge to constantly buy and sell. Instead, they should wait for those moments when the market's inefficiencies present a clear advantage. For the individual investor, this means doing thorough research, buying into companies with solid fundamentals, and holding onto those investments through market ups and downs. The patience to hold investments for the long term allows one to ride out volatility and benefit from the growth of the companies and compounding returns. Buffett's own investment history, holding some stocks for decades, exemplifies this patient approach and its potential to yield substantial rewards. Now we understand the importance of being patient. Let's move on to building a concentrated portfolio. Warren Buffett's investment philosophy deviates from the conventional wisdom of portfolio diversification. He often quotes the adage, "Put all your eggs in one basket and then watch that basket carefully." This encapsulates his strategy of building a concentrated portfolio. Buffett's rationale is that diversification can protect against ignorance, but if you understand a business intimately, the need for broad diversification diminishes. He advocates for investing in a select few companies that an investor has thoroughly researched and strongly believes in. Buffett's approach is predicated on the idea that a concentrated portfolio allows the investor to focus on the performance and prospects of a handful of companies. It's about quality over quantity. By investing in a limited number of companies, investors can allocate more time and resources to understanding their investments, thus making more informed decisions. For investors, this means doing deep due diligence and committing to companies with excellent long-term prospects, strong competitive advantages, and outstanding management. It's a strategy that requires discipline, conviction, and a robust tolerance for market fluctuations, as a concentrated portfolio can lead to higher volatility. However, if executed with care and insight, it can lead to outsized returns as evidenced by Buffett's own track record with Berkshire Hathaway. Margin of safety. The concept of a margin of safety is central to Warren Buffett's investment strategy, a principle he adopted from his mentor, Benjamin Graham. It's a simple yet profound tactic. Only purchase securities when the market price is significantly below its intrinsic value, effectively creating a cushion to absorb errors or unforeseen events. This buffer is the margin of safety. Buffett's application of this principle is akin to a shopper looking for bargains. The price paid must provide ample room for profit based on the investor's assessment of the value of the asset. By insisting on a margin of safety, the investor is protected in case their analysis is off or if the market takes an unexpected downturn. It's not just about finding quality businesses, but buying them at a price that ensures a high likelihood of investment success. For investors, this means rigorous analysis to determine the true worth of a business, considering all aspects of its operations, financial health, and growth prospects. Then, it's about having the patience to wait for the opportunity to buy at a price that offers a margin of safety. This disciplined approach minimizes the risk of loss while providing a greater potential for gains, embodying the conservative yet highly effective investment philosophy that has made Buffett one of the wealthiest individuals in the world. Avoiding debt. Warren Buffett's stance on debt is clear. Avoid it, especially when it comes to investing. He warns against the use of borrowed money or leverage to finance investments because it introduces greater risk to the portfolio. While leverage can magnify returns when investments perform well, it can also amplify losses if investments go south, potentially leading to financial ruin. Buffett's cautionary advice stems from the fact that debt must be repaid regardless of how well the investment performs. This can create a precarious situation during market downturns, where investors may be forced to sell at the worst possible time to meet debt obligations. Additionally, the interest expense from debt can eat into investment returns. For individual investors, Buffett's guidance is to invest only what you can afford to lose without the use of leverage. This conservative approach may limit potential upside, but it also protects against the downside, ensuring that investors can stay in the game for the long term. It's about building wealth steadily and securely, rather than chasing quick profits through risky financial maneuvers. Warren Buffett's principle of inaction is a counterintuitive yet fundamental aspect of his investment philosophy. It's the understanding that not every moment requires action. Sometimes the best course is to maintain the status quo. This principle is rooted in the belief that the compulsion to constantly trade is more about speculation than investment. Buffett asserts that frequent trading often incurs unnecessary costs and taxes and can be driven by emotional responses to market noise rather than rational decision-making. Buffett's strategy is to invest in companies that have long-term growth potential and to hold onto these investments through market fluctuations. This requires a disciplined approach to resist the urge to react to short-term market movements. The principle of inaction doesn't mean inattention. It means being fully informed and ready to act when the right opportunity presents itself, which may not be as often as one might think. Thank you for watching. Please don't forget to subscribe and turn the notification bell to stay updated with our content. Have a wonderful time. I will see you in the next video.